Okay. Oh, got some of my essential students in the classroom right now. Awesome. My back is awful. Here, let me go in and first thing we'll do is going back to the class from last Monday. I'm going to go in and share a chart with you real quick, right quick. Should be able to see my screen. I believe you can. There we go. Okay, we're scheduled for about 60 minutes here. It's good to see some of my essential students in the class. Welcome, guys and gals. Let's go ahead and we'll start off by showing you dollar Swiss from last week. If you recall, last week we had talked about the lonely bar method, if you will. And, you know, before I even pull up the PowerPoint, I just want to really explain to you that what I try to tell my students all the time, and of course we're covering kind of swing trading and how you can use PitView as a confirmation indicator when it comes to swing trading by showing you some of my own personal methods that I trade. I think the misconception about trading, though, and I hate to sound repetitive or like a broken record, but it is true that most people think in order to have a successful trading method, it has to be some kind of quantitative / algorithmic, really complex trading system that utilizes, indicators and all these different advanced tools. I've found in my own personal trading, for those of you who weren't here last week, that simplicity is key. Never trading with something that you do not understand. And a lot of professional traders, a lot of people that I know, they do trade with really basic trading methodology. Simple support and resistance. All you're trying to do is take an educated guess as far as what's happening in the market, because we're all speculators, and no matter how confident we are in a trade, you always have to know that you're not going to be 100% accurate. It's just not going to happen. So you always have to prepare yourself to be wrong. This was actually one that we weren't wrong on. This is something that we had looked at last week, to where we had a confirmed trend line on the dollar Swiss, and I had covered the lonely bar method, to where we look for a trend line break, but we look for a candle that's completely above the trend line once we have a validated trend line. What is a validated trend line? Once again, technical analysis 101. A validated trend line, first 2 points, the first 2 points create a trend line, and the third point has to validate it. A third bounce validates that trend line and makes it a valid support or resistance level. So in this case, we had a valid resistance level on the dollar Swiss. We got a buy signal right in here off this little candle that closed completely above the resistance level. A lot of people might look at a candle like this, see this little one right in here, and they'd look at it as being like a spinning top. Can't see my screen. That's odd. Can everybody see my screen? You should be able to see the MetaTrader platform up on here. Can everybody see that? I just got a little question in here saying that they couldn't see my screen, so I want to make sure. Yes? Okay. So it looks like we got about 90% of the people, 95% of the people in the class can see it. So you may have to log out and log back in, unfortunately. All right, so coming back to here to this trade, a lot of times what happens, and candlesticks, a lot of people trade off candlesticks, and I understand that. But the thing is, a lot of times when you get, really extreme breaks through a trend line, if you will, through crucial support or resistance levels, especially, whether it be horizontal support or resistance or trending support and resistance, oftentimes you're going to find that you're going to get, a lot of times candles that signal indecision because the market's breaking out into new territory. It's breaking through crucial support or resistance. So when students ask me, well, wouldn't that spinning top right here give you pause, Steve? And the answer is no. You could also look at that as a doji. because I know from trading this that a lot of times when lonely bars, what we're looking for, lonely bar or lonely candle, is just one where the open, high, low, and close is completely above the trend line. At the same time, I didn't have the print screen on, but we also got our confirmation off of PitView on this, showing that the 4 and 1 hour totals had gone green. So it gave us all the confirmation that we needed to take a buy on this. Putting our stop 1 pip below the low would have meant you risked about 50 pips on the trade, and obviously it hit max profit, and from there we've seen the dollar Swiss scream up a little bit. We actually got a big gap up on the dollar strength over the weekend after the Sunday open. A lot of the dollar pairs gapped. You can see this gap right in here as it's coming down and starting to fill it in a bit. In fact, it's when you look at the bottom of that candle right in here, it's almost filled in the gap. But so that was just an example of just a straight up lonely bar breakout strategy. Just to confirm that, very easy strategy to trade with. You can see that if you're looking for things like buying opportunities on dollar Swiss, we have another one that happened right in here that one of my students had sent me, where we had one, as it came and climbed back down, we had another 1, 2, 3 points of impact, if you will, points of reference, to where that could have even given us another trade as far as a buying opportunity. That also formed what we call a Gartley pattern, which is another strategy that we'll be covering in the intermediate class here. So there's our buying opportunity, and this again was all during a time when PairView and where PitView was showing green on the totals, confirming more buying pressure from the market makers. So, looking for those types of trading opportunities, especially when you're looking for, if those of you who have been following me for quite some time, and not only in this class but in my essentials class, know that I'm extremely bearish on the Swiss franc and I'm extremely bearish on the euro. So you always I always look for opportunities to either buy dollar Swiss, or looking for opportunities to short euro dollar. I believe is always a good idea, if you will. So that was a nice little trade that we also took in the essentials class off of a bullish Gartley pattern. So again, very simple strategy. Look for a trend line to form and look for a lonely bar to form for confirmation. Use your PitView to confirm. It can be as simple as just green and red. A lot of the purpose of what I try to go through in this intermediate style PitView class are just very simple strategies that you can utilize PitView in. So with that being said, I'm going to go ahead and pull up my PowerPoint here for the day, and we'll come back to the screen here in just a second. So if you're trading on a 1 hour chart, you would use this time frame on PitView. Yes, on the PitView charts, I generally like to use the trigger chart totals on PairView and on GlobalView to confirm a trade, but I also like to look up to the 4 hour totals also. If those line up, the 4 hour totals and the 1 hour totals on PitView, it's one of the strongest pieces of confirmation you can get in the market, because all it means is that you're trading alongside the market makers. You're trading alongside where the buy and sell imbalances stand with the market makers. Today I'm gonna go on in the intermediate series of the course and teach another type of support and resistance trading that I like to call pass-through levels. Those of you who are in my essentials class, you've already gone through this, and those of you who are PitView subscribers for the intermediate class, you probably haven't seen this before. But this is also something to where it's extremely simple. It's not something that's hard to do. What it is just trying to identify trade opportunities when the market is ranging, if you will. There's 3 market directions. There's up, down, and sideways. One of the things that we've found with my students is the fact that one of the most predictable trends since the beginning of the year was actually on the dollar-yen pair. It was consolidating sideways from January up until now. Just this past week, it's finally kind of broken up to the upside a bit, but it's actually been an extremely predictable pair. but it's also been ranging sideways. It hasn't been this huge bullish or bearish trend. It's literally been trading sideways since the beginning of the year up until this past week. So it was actually one of the more predictable trends in the market that was good for some pretty good trades off of it by trading what we call pass-through levels. Now you'll have to forgive me because a lot of terms that I use in the market, and most of you have heard this before, but I'll say it again. Most of the terms I use in the market, like pass-through levels, I don't know if these are technical terms, but they're terms that when I worked on the options trading desk, they're terms that we used. So I never knew if it was terms that we just used or if it was a broader market term, because I never saw anybody else outside of our organization use the term pass-through level. But you'll get a sense of what it means. It's basically just finding the high probability meet movement of the market to where the market has the highest probability of passing through levels without finding any support or resistance. And you got to use a little bit of discretion when you're finding these levels, because you never kind of pinpointed things to perfection on them. But it can be quite profitable and high probability when you're able to identify the high probability levels in which the market can easily pass through. So risk disclaimer: this is risky. Past performance not indicative of future results. Use risk capital. Cover your butt, basically. Oh, the PitView disappeared on this. That's okay. We can. I don't want to stop the PowerPoint here, but we're fine with white PowerPoints, I'm sure. So identifying pass-through levels. What we're trying to do is we're trying to identify levels in which we can find trading opportunities when the market is range-bound. A range-bound market is not always the funnest market to trade because it is trading sideways. It's hitting off support and resistance levels in the market. It's not making screaming trends, meaning it's not making trends, it's not screaming up or down. It's just, it's basically just sideways. It can be some of the most boring markets to trade, but it also can give you high probability opportunities. And I'll show you how you can use PitView along with just a very simple support and resistance trading method in order to get into possible opportunities when you see sideways markets. And just like we talked about last Monday, this is just this can be done on any time frame. The beautiful thing about swing trading and support and resistance trading is that it can be done longer term, medium term, short term. This can be applicable to really any time frame. So identifying pass-through levels starts off with, we draw lines to the most common areas of support and resistance on a chart. Now remember, support and resistance quite often, especially when the market is trending sideways, it's a common area. A lot of times, unless you're dealing with things like pivot points, you're not going to get a huge amount as far as, you're not going to get, like pivot points or specific levels. Common areas on a chart is you're just looking, when you're drawing support and resistance lines, for the common area. The common area where you see buyers overtaking sellers or buying pressure overtaking selling pressure, and the common area on a chart where you see selling pressure overtaking buying pressure for a resistance level. And what you do is you just try to measure out and measure the range between these levels. Quite frankly, when you're drawing these levels on a chart, as was common when I worked at the options desk, a lot of times there'd be 10, 15 different options traders that would be trying to identify common support and resistance levels, and none of us would have a specific level that would be the same. They'd all be different. They'd all be within a couple of points of each other, but they'd all be a little bit different. But the key is just to be able to identify where the opportunities lie when the market is coming off those levels. It's almost called, you can almost call it range trading or bounce trading. And then what you do is, this is extremely important, because placing your secondary lines, these are called your upper and lower range lines, 20% above and below these levels once you have them identified on the chart. What's 20% mean? Well, especially when you're finding horizontal support and resistance trading levels, or what we call channels on a chart. These levels are just the high probability opportunities that when the market does hit what we call the upper and lower range line, you can find opportunities to either go long or short. What does this look like on a chart? Well, here's the thing. This is one of the main problems that people will have when they're looking at a chart. like the yen. This is the yen back in January, right back in here. And at the time of the PowerPoint when I originally created this, this was during about a 6-month period, 7-month period from January to late July. And this is what the dollar yen looked like, which is one of the more actively traded currencies in the market. Now, most people, if I asked them, where are the support and resistance levels? They might say, okay, well, this is a resistance level, that's a resistance level, that's a support level, that's a support level. I don't look at any one of these areas on the chart as being a support or resistance level. I would call these peak, what we call peak support and resistance levels, which are oftentimes just one point on a chart where you see buyers overtaking sellers or sellers overtaking buyers. But when we're actually really wanting to draw where the actual support and resistance is, you have to look closer at the chart. Like if I wanted to find the common area where I see sellers overtaking buyers, don't ever be afraid to draw your support and resistance levels at where the common area is that you see on the chart. Like in this case, if I connected all these highs, I'm not looking to connect the bodies of the candles or the wicks of the candles. All I'm trying to do is I'm connecting as much data at the peak point as possible to where I say, where is the most common area on this chart where I see sellers overtaking buyers? And obviously that when you draw this resistance level right in here, that would be a common resistance level on the chart. Yes, I know this happens, and I know this happens, and I know this happens. However, we call this the horse poking its nose through the fence line, if you will. We really want to just find the common area. On the bottom side, again, we don't want to go to the extreme peaks on the chart. What we're trying to identify when we're looking at a sideways range is we're trying to find the most common area, the most common floor on the chart where we see buying pressure overtake selling pressure. Believe it or not, there's people out there that will spend hours trying to identify support and resistance levels. It takes me about 2 seconds because I'll just go voop, voop, and draw those two levels on the chart, and I'm good to go. So where are those common levels on the chart here on dollar yen? 102.70 and 101.20. So that means if I had to look at the most common range that the yen had during this time, but just by identifying the peak levels or the common support and resistance levels, if you will, I would look at the range as being about 150 pips. Now what I'm going to try to do is, then this was an extremely predictable trend on the yen, especially when it spends 6-7 months trading sideways, is what I'm going to try to do here is I'm just going to try to identify, okay, now that I have a support and resistance identified on the chart, where's the meat of the movement? That's what we would call our upper and lower range line. The meat being the common area that gets eaten off the chart where you don't see a lot of support and resistance, to where when things are bouncing off resistance, it can easily pass through an upper portion of this trend and you don't see any support until it gets to the bottom end of the range. See, we call that meat trading because you're not trying to get the very, very top. You're not trying to get at the very, very bottom. What you're trying to do is you're just trying to trade the meat in the middle of the movement. So identifying pass-through levels is actually very simple because you would look at the range as being 150 pips. You would take 20% of that, which would be 30 pips, and all you would do is your upper range line from that peak resistance level you draw, you would subtract 30 pips, and that would give you what we call your upper range line. The lower range line you would add 30 pips to, and that would give you your lower range line. These would also, a lot of traders might call these what we call your trigger lines. What that means is when things get down into those overbought and oversold levels to the lower parts of those range, those lines would be the trigger lines of when things are coming out of those ranges where it would actually trigger a trade for you. And again, this is not that difficult at all to identify. So in this case, if we're looking at this on a chart, there's our upper and lower range line. There's our upper and lower range line. That was our support and resistance levels. And we call this the pass-through level. Whoops, sorry. I didn't mean to click that. That's so fast. So the question that's going to come up here is, why do you call it a pass-through level? I know I already explained that once, but I like explaining this. Whenever you're range trading, again, as a trader, there are certain strategies, where you can try to pick the very, very bottom of a trend and try to pick the very, very top of a trend. Imagine this upper line right over up in here. Imagine this being the bun. Imagine these are all little sesame seeds on a bun. That's the top bun on a hamburger. This is the bottom bun on a hamburger. And this is all the meat in the middle of the movement, right in here. The reason why we call them pass-through levels is because if you look at the level in between these upper and lower range lines, if you look at the area in between there, what you'll find is that whenever price has gotten down, come down below this level, it doesn't really find a huge amount of support until it reaches the lower range line. And it doesn't find a whole lot of resistance until it gets up to the upper range line. And so this is just the meat in the middle because it's the highest probability area on the chart that price can easily pass through. And sorry, I've gotten a little addicted to drawing on the charts, but that's why we call them pass-through levels. So it makes sense when you think about it that way. It's just a lot of times when you're trading, and this can be applicable to many different strategies, try to look more at the middle of the chart than you do at the extreme peaks and peaks and valleys, if you will. If you look at the middle of the chart, oftentimes you can gain a lot of clarity as far as, where does price tend to fluctuate, where it does not find a whole huge amount of support or resistance. And you get that by looking at the meat in the middle of the chart. Now, we also consider these to be overbought and oversold levels. Overbought whenever something is range bound is when the price is trading between the upper range and resistance, the upper range line. And what we try to look for, you can almost look at this as an indicator like a stochastic, is we're looking for our trade entry once the price retraces below the upper range line. And remember, the upper range line can also be called our trigger line. And oversold, when things get into oversold territory, that just means the price is trading between the lower range and support. And so what we're looking for is for price to retrace above the lower range line, also known as our trigger line for our entry. Overbought and oversold levels, I often tell people, is that when people ask me, Steve, do you use things like stochastic or RSI or CCI? Do you use these types of things to identify overbought and oversold levels in the market? And the answer more often than not for me is no. I don't really need those types of indicators to identify overbought and oversold levels because the price is really what tells the story. For example, one of the things I like to bring up to students is if we go to this next chart in here, we have our overbought and oversold levels when price is trading between the upper range line and resistance and the lower range line and support. So we would consider it to be overbought every time it's in these levels and oversold every time that it gets in between these levels. Now, when you're looking at things like that, do I really need something like a stochastic to show me when things are in overbought or oversold? Like this would be oversold right down in here on a stochastic, and up here between the in the upper 20%, that would be considered overbought. Do I really need George Lane and his percentage K and percentage D to tell me when things are overbought and oversold when something is range bound in the market? No. You can look at kind of where the overbought and oversold levels are in the stochastic, and they show up right about the same places where it gets overbought and oversold on the daily chart. So when you're able to identify these types of levels, congratulations. You just created your own little technical indicator, if you will. A price is it's something I always love to tell people is price is what tells the story. Oftentimes when you have an indicator like stochastic and RSI and CCI and a lot of these different momentum oscillators on the bottom of your screen, all it does is really detract you from what's actually happening with the price itself. So always remember that as kind of just my little tidbit to you is that, no matter what type of price or momentum indicator that you have on your chart, price is in the end, price is what tells the story of what's actually occurring. Not that indicators are bad. I just don't like my students to get what I like to call indicator dependent. You know, the best indicator for trading is the gray matter between your ears and just being able to make common sense out of things. Pretty interesting when you think about it. So Steve, if I'm identifying those levels on a chart, how do I actually identify a trade? Well, get ready to have your mind blown, because this is where it gets really complex. If you're using just like if you're identifying these types of levels on longer term, let's say daily chart, and I also put PitView into play on here. The sell entry would be once price closes in the overbought level. Oops, sorry about that. Once client price closes into the overbought level, sorry about that, I had to change something. Once price closes in the overbought level between the upper range line and resistance, you would sell once the price closes on a daily chart below the upper range line. So that's called a touch and close. You're waiting for it to touch and close in the overbought territory, and then you're waiting for a following candle to close below that upper range line. What also tends to keep you out of whipsaws is looking at the 24-hour pair view totals. 24 hours is one trading day in the market, so this can really help you as far as being able to confirm that there is going to be a shift in momentum. And yes, you can put pair view to a 24-hour total time frame. I can show you how to do that here in just a little bit. So you would want just the 24-hour pair view to be confirmed as red. Now I know a lot of you will look at this and say, well, you know, Steve, what I would really like to see is, you know, how much do I want the buy or sell imbalance to be? You know, how red do I want it to be? Do I want a -20 or a -5 or a -10 on the imbalance? When you're looking at a 24-hour period in the market, it just has to be red. Red will signal a sell imbalance for the last 24 hours in the market with the market makers. So that would just signal and confirm for you. It will keep you out of a lot of whipsaws, because when you do eventually sell off a sell entry on this, you'll know that you're on the right side of where the overall market maker activity is. And again, on the buys, once the price closes in the oversold level, you would buy once price closes above the lower range line and the 24-hour pair view. And this should be the 24-hour. You're always, as far as leaders versus followers, you're always looking at the total section. I forgot to add that in there. Sorry, the total section. I'll show you that on the next chart. So you're looking at the 24-hour pair view totals to confirm these buys and sells. And oftentimes that'll really help you out when it comes to avoiding whipsaws in the market. The stop order is actually very simple. We always look at, you know, previous swing highs and lows. But what you want is on your stop orders, you want your stops at least 1 pip outside the support and resistance levels that you drew on the screen. This is where some discretion can come into play on this, because you want it, remember, you always put your stop orders where you're wrong. So you want them to be outside of previous support and resistance, because if you go short on something, in order for the market to shake you out of the trade, you want to make sure that they prove you wrong. If you're short something and you think it's going to go down, they need to prove that they have the brass cojones to take it up. In order to do that, you want to make sure that you have it outside of a previous resistance level if you're short. Same thing on a buy. You want to make sure you have your stop order outside of a previous support level, because you want to make sure that the market has the brass cojones to break something into a new low in order to shake you out of a trade. Especially if you're trading off daily charts, you want to make sure that you never put your stops too tight, because yes, your stop could be quite a ways away from the market, but you know, you're also looking for larger amounts of pips when you're trading off a 24-hour time frame. So a limit would be 1-to-1 risk reward. 1-to-1 risk reward always being our starting point. Based on where your stop is, that is your risk on the trade from your entry to your stop order. Especially on these range-bound trades, you know, your starting point's always going to be whatever you're risking per your stop. That's going to be your minimum reward potential on the trade. That keeps you in what we call a square deal with the market. So an example of what this would look like on a daily chart. Again, we have the price right down in here. it closes in the oversold territory and then closes above. That gives you a buy signal. Remember, you're looking for it to close in oversold and then the previous a candle following to close in your overbought territory. Your stop, you want at least to be below this green line. You can also, if you have a swing low on the chart, that would be representative on the chart, you can use that also if you really want to put your stop at some more extreme levels. But your stop, you want to just make sure that it's at least outside of that support level, that common support level on the chart. Your sell entry, again, you have price closes right in here in the overbought territory. And there you go. You get a close right down there on the red candle, right below the upper range line. And that would give you your sell entry. At the time that I created this individual PowerPoint, I also took a snapshot. On the dollar yen, you can see here, this is, on the dollar yen, you see this is a 24-hour total on the dollar yen using the pair view. A lot of times when you're looking at pair view, and the more time that you bring into PitView, the more time that you're giving the market, that you're trying to calculate buy and sell imbalances, the smaller the actual total imbalances will be. In this case, it's a negative 0.02. It's barely red, but it is showing a sell imbalance. That's all that I care about when I'm looking at something such as this. I just want to know for a fact that I have a large sell imbalance or some type of sell imbalance in the market. And I'm always looking at the total section, and generally I'm going to be looking at based on 100% of the market maker activity. The reason why is one thing to remember about market makers, and this is just a little education on how liquidity providers work, is in the long run, liquidity providers, remember, buy and sell imbalance would be, you know, if 60% of their activity has been on the bid and only 40% has been on the ask, that would be a positive 20. If there was 40% of their activity was on the bid and 60% was on the ask, that would be a negative 20 as far as a buy or sell imbalance goes. Generally speaking, you get the larger imbalances on the shorter time frames. 4-hour charts, 1-hour charts, 5-minute, 1-minute is going to show you the larger imbalances. The more time that you bring into a PitView scenario, like looking back 24 hours, in the end, in the long run, liquidity providers ideally want to be right at 50-50. Remember, they're making most of their transactions off that transaction between the buy and sell price, that little transaction cost or spread between the buy and sell. So generally speaking, they want about 50% in the long run of their activity on the bid. They want to be all square at some point over the long run. So the more time that you put into these PitView totals, they will show imbalances, but it's going to be, the imbalances will be smaller the more time that you put into PitView to measure, essentially. So all we're looking for is for it to be, in this case, on the sell entry in here, we're just looking for it to be red. Red or green, and all you're using it for is confirmation. Do you think it gives you a little bit more added confidence on a trade if you're taking a sell order? If you know you're on the side, same side as all the market makers that are being measured, if most of their totals also favor the sell side of the equation, in this case, if it's just red, it can give you just that much more confidence to take the trade, and know that, you know, you're not going to be right 100% of the time off of it, but it can keep you from being whipsawed in and out of trades. In fact, the last little sell signal this gave right before the dollar yen took off to the upside, the imbalance was favored the buy side. This was given a sell signal, and this little area right in here was actually green. Pretty interesting. So you can trade it off a daily chart. You can just use one time frame. A lot of times what I do is I look at the daily charts a lot of times to find what the prevailing trends are, to look at the bigger picture in the market. And I do a lot of my trading off of 1-hour charts. That's usually the starting point for me whenever I'm doing any swing trading. I'll look at the 1-hour charts and the 1-hour time frames. So as far as an alternative for entry on this, if you like trading with shorter time frames, you can use like a lonely bar method for trading this. You can look at those upper and lower range lines as being support and resistance levels and wait for a lonely bar to form. Now this is all going to be based on personal preference. For me, a lot of times I'm going to be using a 1 hour chart on this because that's what I look for a lot of pattern trades off of, 1 hour time frames. But I know a lot of you out there also like to trade off of 4 hour charts. This would just be whatever your personal preference is as far as a trigger chart goes. Now, your sell entry on this is based on what I like to look at, which is the 1 hour time frame. So this was based on more this one right up in here that I try to look at, especially when it comes to PitView, is the 1 hour time frame up in here. So the sell entry would go like this. Once the price closes in the overbought level on my 1 hour charts, I would sell once a lonely bar forms below the upper range line. So I would be looking at the upper and lower range lines, all the support and resistance levels I would have drawn on my actual daily charts, and then I'll have them still showing up when I go to my 1 hour charts to see where those overbought and oversold levels are. But in this case, I'm looking for an added confirmation. On the 1 hour time frame, I want the lonely bar to form below the upper range line. Now on my 1 hour time frame, I use the same confirmation that I do on the lonely bar method, which is specifically on my trigger charts, the pair view. I want the 4 and the 1 hour totals to be red if I get a sell signal. So if I get a lonely bar forms below that upper range line for a sell, I want the 4 and 1 hour totals on pair view to be red. For buy entries, once price closes in an oversold level, I would want to buy once the lonely bar forms above the lower range line, and the pair view 4 and 1 hour totals are green. So that's based on my 1 hour time frame. Question comes up here, what if I trade off of a 4 hour chart? Well, you would look for the same thing, a lonely bar to form on a 4 hour chart instead of a 1 hour. In your case, you might just look for the 4 hour pair view to be red or green, and possibly you can even move up a time frame to like an 8 hour pair view if you want to look up a little bit more for confirmation. You know, the more you look up on the charts, the more the longer time frames confirm your trade, the better, because those longer time frames are part of the prevailing trend. I'm just kind of showing you how I do it on the 1 hour. What if the 4 and 1 hour pit views disagree? Well, if we're using, one of the reasons why I show this quite often to my student, as far as the pair view, one of the reasons why I started using PitView to begin with is a lot of times if you're using the PitView as an actual confirmation. Now, a lot of my students don't have access to PitView, so they would just take this pair view part out of it. The reason why people use this, a lot of institutions use this, is in my case, if the 4 and 1 hour totals do not agree with this trade, I would either wait until the 4 and 1 hour totals did go red to confirm it after I got a lonely bar to confirm the trade if I'm using that as a trade filter. Otherwise, I wouldn't place a trade, because that's where people bring PitView into the equation, is they use it for added confirmation on their trades to keep themselves from being whipsawed in and out. So essentially, you would look at this, Phil, as that's why people get this, use this product, is for added trade confirmation. So if the 4 and 1 hour totals don't line up, if they're both not red or they're both not green on the chart, then you would wait for them to line up, or you wouldn't take the trade, because that's that's the whole reason why people subscribe to this. I'll show you. I'll certainly show you how to get the 1 hour totals. So the same thing occurs. You want your stop to still be outside the support and resistance levels, a limit of 1-to-1 risk reward. What trading this type of thing on a 1 hour chart or a 4 hour chart does is it oftentimes can get you into these trades earlier, and for more profitability, and even perhaps a higher risk reward ratio on your trade. But range trading is essentially one of those things to where you just wait for it to get into the upper or lower part of the range, and you have to be patient a lot. Quite often you have to be very patient when looking for these types of scenarios to occur. Here's one that I captured with the PitView on here, to where we had a sell, we had it close in the oversold level right in here, and right here you can see it. That's, again, a lot of times when these things break into new highs or whatnot, we get a lonely bar that occurs right in here that gives us a buy entry. We also have the 4 and 1 hour totals during that time frame are both green, so that checks to where I know when I'm placing this on a 1 hour chart, I know that I have it confirmed by market maker action for my buy entry. So there would be my buy entry. The stop order, here's our lower support level right in here. Put our stop at out. It has to be at least 1 pip outside the lower support level. Now, these lines that are drawn on here, even though I'm trading this off a 1 hour chart, these are those lines I established on the daily chart to show me where the overbought and oversold levels were, to show me where the range lines were. Oftentimes when you're looking at these levels, the longer the time frame, the more data you're looking at, the better as far as identifying these levels. Almost like pattern trading, the longer a pattern takes to develop, the stronger a pattern is. Other entry options that we can go through, Fibonacci retracements, when something retraces by a certain Fibonacci percentage, lonely bar trend line breaks, the Gartley pattern, which we'll be covering next Monday. These are all things also that can give you entry options on these trades, because all we're really looking at is support and resistance. Now let me go back here. Let me show you another example of this. For example, like if I, a lot of times these trades, they kind of line up together. Like right in there, it's not a pretty one, but you can see I got 1, 2, 3, 4. I got 4 points of reference for like a trend line on the 1 hour chart. When this buy entry occurs on the above the lower range line, it's also breaking out from a longer term trend line. That's a beautiful thing about trading with support and resistance, is oftentimes a lot of support and resistance methods will line up together. Like this would even be looked at as a double bottom right in here on the chart as it forms. So there's a lot of things, a lot of ways of support and resistance. The more things kind of add up, oftentimes a higher probability that can be established. All right. There was another question on here that I didn't get a chance to look at. Once you get into the trade and the 1 and 4 hour totals are green, would you get out when the 1 and 4 hour the 1 and 4 hour totals turn red? No. If my limit has not been reached of at least 1-to-1 risk reward, for entry confirmation, just like on a lonely bar, when you're using something as an entry confirmation, you're trying to find the best entry trigger possible. A lot of times when you get into trades, and this goes to any tool, whether it be a stochastic or a MACD, or even moving average crossovers or PitView, you're looking for something that confirms a good solid entry into your trade, the high probability entry scenario. Now this gets back into a more complicated process as far as that question goes, is it depends on what that imbalance was. On the 1 and 4 hour totals, if the total imbalances went to like a -20 or a -25, then yeah, that might tell me maybe you'd want to consider closing this trade earlier. However, if they just go slightly red to like a -5, -4, this is where knowing kind of what imbalances show up on the chart, what would be considered a large imbalance. So no, not necessarily would I get out of a trade if for example, if I took this buy signal and the 1 and 4 hour charts went red. It would have to depend on what the extremes of that red would be. Generally speaking, especially like the 1 hour charts, 4 hour charts, and lower, the plus 20 and minus 20 imbalances are oftentimes when you see large shifts in market conditions. But no, it won't necessarily take me out of the trade. And again, a lot of trading can be discretionary. It'd be taken on a case-by-case basis, but it wouldn't necessarily get me out of a trade. I'm using PitView a lot of times to help me confirm into a trade. All right, that's a great question. You know, it's kind of goes back to, and we're going to go live in here, and I'll show you what this looks like. A lot of times this goes back to, you know, for example, on moving average crossover trading. You know, if you're using a short and long-term moving average to buy and sell, if I buy when a moving average makes a positive cross, I won't necessarily sell if it makes a negative cross. Why? Because, you know, as markets fluctuate, if I'm not reaching that minimum of 1-to-1, at least 1-to-1 risk reward on the trade, you're trying to at least make back whatever you're risking on the trade when you get in. So it all can be taken on a more discretionary basis of whether you would close out a trade early or not when you get what we would call an opposing signal. It all depends on the extent of that opposing signal and the circumstances around it. What I find PitView works best for is for entry confirmation. It can keep you into trades longer once it reaches your limit price. For example, if it hits your limit and you're about to close out your trade and take a profit off the table, but PitView is still showing green, you might consider staying in the trade a little bit longer as it climbs up until it goes red to confirm that market makers are going to more of the sell-in balance to kind of make you more profitable on a trade. However, if you get in and you get about 20 or 30 pips on the trade and you're looking for, you know, to risk 50 to make 50, and it just barely shows red showing up in the PitView, you know, I'm not necessarily going to be shaken out of the trade at that point, because I kind of expect the market, once it changes and shifts direction, to make higher highs and higher lows as it comes back up, to have some type of drawdown, if you will, as the market goes back up in my direction. So again, it would probably all be taken on a case-by-case basis. All right, let me go in here and I'm going to switch to a different screen. Pull over the dollar yen here. The dollar yen is one that you can kind of see on here has recently broken its trend a bit. Last week was a big week for dollar yen. It went up and approached that 104 level, closed above it. That's where it's trading right at now, right at that 104 level. But here's what we call our pass-through levels on the chart. You know, all I do when I'm pulling up a chart such as this one, and here I can switch it over to a more basic view, zoom in a bit. Again, wasn't expecting that to happen here, but let's see here. See, what I did there was drawing the horizontal lines. Is remember, when you're putting the horizontal lines on the chart, when you ask how did I get those support and resistance levels, don't stress out too much on them. You know, just look for the common areas where buyers are overtaking sellers and the common areas where sellers are overtaking buyers. Once you get pass-through levels drawn on a chart, you can change the color schemes and such, but you know, you use the horizontal lines once again to do what's called your upper and lower range lines. Once you see a market is, somebody had a question in here, just how to draw the lines on the chart. That's what I'm going over first. You just use these horizontal lines up in here on your MetaTrader, or most charting platforms have some kind of horizontal support and resistance line drawing that you can do on a chart. So you just click on those horizontal lines. If you're using MetaTrader, you can actually, if you right-click on the lines, you can change the color scheme. So if you're asking how my color scheme got changed, you can just double-click on the color scheme, and that'll change your colors around. And that's how you just draw the lines. You can customize them, and once you have them saved on a chart, if you want to save them, you can right-click in the MetaTrader anyway. You can right-click, go to your template, and save it as a template. Like you can see, I had it saved as a Japanese yen pass-through level on here. And once you save it, then whenever you're in here, all you got to do is click on the pass-through level template, and it will show you where they're at. So I just wanted to take you to MetaTrader real quick and show you how to draw those. But you can see the yen is climbing. You know, it's up here right up the 104 level, up here at the top. However, you know, you would still keep these levels drawn on your chart. It's no different than it getting up to these levels back here. You know, I'm going to be taking a close look at dollar yen as we get into like September, October especially, because you never know. This could be the start of a longer term upward trending movement on the yen. But even though it's trading in these levels, if you were looking to sell it again, you know, I would even tell people, you know, every time that it gets into this meat part of the movement, that it has really not a whole lot of problems passing easily between these levels without getting and breaking into new highs or lows. So that's one of the reasons why we use those types of levels, is we use them to find where's the path of least resistance if it gets down into this territory right down in here. So the answer to that question is I would keep these levels on here. If the yen comes back down into these levels, at least you know where the highest probability exists when it gets there. As far as the PitView, I said I'd show you how to set up the 24-hour time frame on it. If you open up a pair view screen, let me open up another one here, get a different time frame. When you open up a pair view screen, let me show you this real quick. I know a lot of you, and this question got asked last week, when you're looking at things like pair view, a lot of you can get really confused or get what I like to call analysis paralysis, because a lot of times when you open up pair view, it'll show you like different time frames. It'll show you like the leaders, the followers, the totals for the hourly basis, leaders, followers, and totals on the 5-minute basis. The way I get my pair view set up is I'll right-click on it. If you right-click anywhere in the pair view and go to show and hide columns, I'll take all the leaders and followers out for the session leaders and followers. These are your hourly charts, or your hourly PitView totals here. And I'll take all the minute by minute, especially if I'm trading off of 1 hour time frames, I'll take that whole right-hand column, I'll uncheck it. And this is something that I would recommend for a lot of you, is especially if you're starting off trading this, is you may not want to start off by looking at, you know, leaders, followers, and multiple time frames. Just keep your eyes focused in on what we would call our trigger charts, and possibly another time frame. But you can see I have it set up as like a 4-hour total on there. Now to change it to a 24 hours, what you do is you would right click, and you see where it says change time frames and sessions. I'm going to click on that. And when you go into here, let me just show you something real quick. In order to look back 24 hours, they have what are called auto and rolling sessions. If you're on auto sessions, a lot of times it's not going to let you go back 24 hours, because what it's going to do is it's going to automatically reset the PitView every time the Sydney session opens, every time the Tokyo session opens, and every time the London session opens, or the US session, it'll reset it. So without going too further into that, because that's something that we can talk about another day, but what I'll show you, to get it set to 24 hours, just make sure the session is set to rolling. Okay? Under the session length, you'd have to go under session length in hours. Don't change the minute one. You would change that to 24. And you can go back, I believe you can even go back, somebody told me you can go back even like 72 hours and more when you change it to rolling. I believe you can go back quite a long time on that. Click on apply. And there you have a 24-hour total. Now you see here, when you're looking at something like dollar yen, when you're looking at the total percentages, a lot of times when you're going back 24 hours and more, I mean, when you're looking back, 1, 2, 3 days, since you're looking at all the market maker activity for a 24-hour period, you're not going to see huge buy and sell imbalances occur, because at the longer time frame that you look at, the more market makers or liquidity providers want to try to get back to 50-50, if you will, over the long term. So you can see that it favors a bit on the sell side of the equation right now. On the end, there's a bit of a selling pressure or sell imbalance. So going back in the longer time frame, sometimes it's better just to go green or red, if you will. Let's see here. I'm out of time here, but to go into kind of further details on other things, but let me just show you. Let's hold on one second. I'm looking at some questions as they pop through on here. If you allow me real quick, let me go back to a chart and just let me show you some things on here. These types of pass-through levels, when you're identifying them on a chart, no matter what time frame you're looking at, if you like to trade off of shorter time frames, oftentimes, and here, let me go to, well, this will be fine. I believe dollar Swiss. You can find pass-through levels in any time frame. If you're just what you're trying to eyeball when you're a trader, is you're trying to find the level on a chart that if the price gets in between into that level, that you don't have a huge amount of support or resistance. For example, dollar Swiss. Somebody asked this to me of me in my class. I believe it was last week. There's a common resistance area. This is one that we were looking at last week. There's a common resistance area right at 9,100. And if you connect the common support levels in through here, there's a common support level that you can find down in here at about the 90.40 level. And this is on a 4-hour time frame. So if you're looking for the meat of the movement, let's see here, that's about 60 pips. So you can still put on, these little lines, horizontal lines, 20% above the upper range line, depending on what the range is between your upper and lower resistance levels. And you can still try to identify on the chart that, okay, a lot of times it's really helpful to have these types of areas identified, because if it gets down into these areas that it doesn't have a hell of a lot of problems passing through this middle part of the movement. So, if you're doing this on a 4-hour chart, maybe you could also use like a 1-hour chart to identify when it, same type of strategy, get into the overbought and oversold territories and wait for it to come out of those levels. This type of support and resistance trading, it can be applicable to any time frame, not just daily charts, but also any time frame. I use the dollar yen as a good example because, when you look at it, the dollar yen on those daily charts, that was probably, if you were looking for the most predictable trend so far in 2014, from January up until just recently, the most predictable trend out of all the currency pairs was really the yen, and it wasn't predictable to be bullish or bearish. The predictability of it was the fact that it was just going sideways. So of course, the longer time frames you use, the better off you're going to be. All right. With that being said, I have run out of time here. This was not a very complex subject matter. I do understand that. So if you do have any questions, you can feel free to email me at steve.nuri@pitview.com. The majority of people in here, except for my essential students, are already PitView subscribers. But if you do need to subscribe or need a demo account, you can go to this link right in here, pitview.com/web. If you need to get a demo account open, or if you were looking to subscribe, you can also email me, steve.nuri@pitview.com. More than happy to field any questions. A lot of you have been emailing me about because I do work for PitView because I do believe it's a very strong tool and indicator, but my main passion is again, a lot of you have emailed me about my personal education courses, which include a lot of this type of support and resistance trading. which I offer to PitView subscribers also. So that consists of live analysis that I do with my students every Tuesday and Thursday morning, and we also go through some structured education on that. Again, if you do have questions on that, you can also email me here at this PitView email address also. So just let me know if you have any questions. I will chat at all of you later, but just let me know if you do need anything. And next week we'll be talking about Gartley pattern. We'll be showing you how to use PitView to confirm Gartley patterns, which is a very powerful pattern in the market, which I think you'll really enjoy. So until then, I will catch everybody next Monday. Thanks for coming in today. Bye-bye.